Okay, let's continue our discussion on corporate governance. Today, I'm gonna finish this chapter. So now we talk about regulation. Remember what is the main concern here? The main concern is we concern the conflicts of interests between managers and shareholders. And because of this, we have to examine different kind of mechanisms which could reduce these conflicts of interests. And in the last class, we talked about board of directors. And today, we talk about regulation. So basically, you can consider board of directors is a very important internal control mechanism. That is, it's the control that the firm uses internally to monitor its CEOs and other managers. And outside of these internal controls, we could also talk about external control. And government regulations and laws can be considered as external control. And we will talk about first the SOX Act, second the Dodd-Frank Act, and then we will talk about insider trading penalties. So SOX Act was passed in 2002 in the US. It was actually motivated by several accounting scandals, famous ones, Enron and WorldCom. And because of these accounting incidents, these problems, the US Congress passed this SOX Act. And SOX, the purpose of SOX was first overhauling incentives and independence in the auditing process. And second, increasing penalties for providing false information. Third, forcing firms to validate their internal financial control process. So let's talk about these three pieces one by one. Okay, first, overhauling incentives and incidents in the auditing process. There are several requirements. First, the amount of consulting fees that an accounting firm can charge from the same firm it audits is limited. So you can see the goal here, right? So basically, a accounting firm, say EY, can audit the firm, and for the same firm, it can offer some consulting service, no matter transfer pricing or some other even management consulting. Anyway, the law says you can have only limited consulting fees if you're auditing the firm. So this will prevent this conflict of interest, right? Because you can imagine that if the accounting firm has charged a lot of consulting fees from the firm it audits, then you will think possibly the auditing process itself has been compromised. Okay, second requirement, audit partners to rotate every 5 years. So this basically prevents auditing partners to get too close to management, right? Third, requires independent audit committees and at least one outside director have a financial background. So this is the requirement on the board of directors. It basically means all directors sitting on the audit committees have to be independent. So this obviously wants to provide better oversight to the firm's financial reporting process. And at least one director needs to have a financial background. So this basically means the law requires the independent audit committee to have the expertise to understand the auditing process. Okay, second, increasing penalties for providing false information. So under the SOX Act, both the CEO and the CFO, they have to personally attest to the accuracy of the financial statements. And if false or misleading financial disclosure was discovered, then the penalties would be up to $5 million and imprisonment of 20 years. And then the third one is about the so-called clawback provision. So it basically says if there is a restatement, then CEO and CFO, they have to return their bonuses or profits from stocks and options which were awarded during that period, right? So this basically means the law wants to hold CEOs and CFOs financially liable for any mistakes in financial statements. Okay, third, firms need to validate their internal financial control process. So this is the famous SOX section 404. So section 404 basically says senior management and the directors, they need to be willing to attest the effectiveness of their internal control process. This one is supposed to be very expensive, and it has put a lot of large burdens on small firms. There are a lot of papers on this, and the recent estimates based on this organization, Financial Executives International, and the American Electronics Association, they predict the actual cost would be between $20 billion and $35 billion. So the compliance cost of Section 404 is actually pretty high. Okay, and then because of the 2008 financial crisis, the U.S. Congress passed the Dodd-Frank Act of 2010. So this one has the following requirement. First, independent compensation committee. So this basically says all directors sitting on the compensation committee, they have to be independent. So the goal of this piece of requirement is basically to the goal of this requirement is to increase the effectiveness of compensation policies. Okay, second, shareholders with at least 3% ownership for at least 3 years can nominate directors. So this is related to the shareholder voice. Basically, under this act, shareholders, they will get louder voice. Essentially, it means that if I am the shareholder, I have 3% ownership, and I have been the shareholder for the firm for at least 3 years, and if I don't like these directors recommended by management, then I can nominate my own directors. Okay. Then at least once every 3 years, firms must provide shareholders with a non-binding vote on the compensation of the firm's CEO, CFO, and 3 other most highly paid managers. So this one is related to say on pay. That is, we want shareholders to have a say on the pay of CEOs, CFOs, and other executives. And we discussed this in the last class. And the vote on say on pay is not binding. But if you examine the data, even it's not binding, then firms do care about these votes. So if investors, they vote against the compensation of the firm's managers, then generally firms, they will spend large effort to address investors' concerns. So this is effective policy. Okay, clawback provisions. Okay, we just discussed this. So basically, firms, they need to establish policies taking back up to 3 years of executive compensation if there is accounting restatement. Okay, last, more disclosure. So firms must disclose the ratio of CEO compensation to that of the median employee. So this is interesting data point. If you check financial news, then at least 1 or 2 years ago, financial news outlets actually like to report these numbers. So it's the ratio between the CEO compensation and the median employees compensation. Generally, this number is quite large, and you can see that the purpose of this law is potentially put some pressure on the magnitude of CEO compensation, because the public generally thinks CEO compensation is too high. Okay, and then the relationship between the executive compensation and firm's financial performance has to be discussed and disclosed. So this basically says the firm has to explain how executive compensation is determined and how it is related to the firm's performance. Okay, last, the firm also needs to disclose whether it permits its employees and directors to hedge against decrease in the market value of the firm's stock. Okay, the third piece of policies we would like to discuss is the insider trading penalty. So insider trading basically means a person makes a transaction based on private information. So you can consider that, let's say if tomorrow there is a earnings announcement and the firm's earning would be really good, but this information has not been disclosed yet, and the person who serves as the CFO obviously knows this information, and if this CFO trades its own firm's shares based on this private information, then this is insider trading. And there and examples of insider trading could include potential merger and acquisition, and future earnings release or change in payout policy. And the penalties for insider trading include jail time, fines, civil penalties. Okay, last, let's talk about corporate governance around the world. So our discussion so far has focused on the corporate governance system in Canada and the US. And you can imagine that corporate governance varies a lot across different countries. So we will discuss some of these differences here. First is the difference on the protection of shareholder rights. Generally, Canada and the US have good protection on shareholder rights, but the degree of this protection varies across different countries. And research has found out that the degree of this protection is largely determined by the legal origin of the country. And research has found that there are more protections in shareholder rights in legal system based on British common law, and there is less protection in shareholder rights in legal system based on French, German, and Scandinavian civil law. Okay. Now we talk about controlling owners in the pyramids. So this one is really more related to countries other than Canada and the US. And in Canada and the US, the main focus on corporate governance is the conflicts of interest between shareholders and managers. But in Europe and in more developed Asian countries, it's more about the conflicts of interest between controlling shareholders and minority shareholders. So it's the conflicts between large and small shareholders. The reason for this is in Europe, Japan, and South Korea, a lot of firms are actually run by families. And these families own controlling blocks of shares. For example, if you look at Volkswagen, it is controlled by the, I think it's Peach family. I hope I am correct in the pronunciation here, but let's just call it Peach family. So VW is controlled by Peach family with about 30% ownership. So here we consider that if a family controls over 20% of the firm, then we will consider this family has this controlling ownership. The reason is because you can imagine that if you're the largest shareholder, right? Even if you have only 20%, but all other shareholders, they have smaller ownership compared with you. And this generally means you will have considerable say in the operation of the firm because you're the largest shareholder, right? So you have a lot of decision right. Even if other shareholders, they don't agree with you, but if they want to vote against you, these small shareholders, they have to coordinate together, and coordination among 1,000 shareholders is definitely hard. So this is why even without 50% ownership, right? Let's say you just have 30%, we would still consider you as the controlling shareholder. And in these firms controlled by families, there is very little conflict of interest between the controlling family and the management. The reason is obvious because the management is often made up of family members. And the main conflicts would be between the small shareholders and the controlling family. Now, let's explore how these families, they exert control on these firms, even if they own less than 50% of the firm. And there are two tricks or techniques these families can use. The first is dual class shares. The second is pyramids. So first, dual class shares. Just from the name, you can see that it's pretty easy to understand, right? It basically means this firm has two classes of shares. And generally, one class will have much higher voting rights over the other class. For example, here we're looking at at Facebook, right? So Facebook, let's say it has it has two classes of shares, Class A and Class B. So for Class A, now if you look at its voting rights, so for Class A, it's one vote per share. And this is the type of share you and I can get if we buy Facebook shares. And then there are also Class B shares, and it's 10 votes per share, right? So in the case of Facebook, the CEO and founder, Mark Zuckerberg, so he controls 90%, he controls 75% of Class B, right? 75% of Class B. And this gives Zuckerberg 58% of Facebook's voting power. So this basically means Zuckerberg, in terms of the voting power, is definitely the controlling shareholder here, right? And if you look at ownership data, then you can see that Zuckerberg has about, I think it's about 25 or 30% of ownership, yet he has 58% of voting power. This is really because he owns these Class B shares, which has 10 times voting power compared with Class A shares, right? So this is the trick these firms, feminists or founders, they can use. And in the US, dual class shares are less common, but dual class shares are pretty common in a lot of countries, right? Including Canada, Brazil, and European countries. And then in Belgium, China, Japan, Singapore, and Spain, dual class shares are banned. Okay, the second trick these feminists can use to control the firm is pyramids. So let's see how this works. So let's say first, the feminine first controls the first firm with, let's say, 50%, right? And then firm 1 will buy 50% of firm 2's shares. And firm 2 will buy 50% of firm 3's shares. So we have firm 1 and firm 2 and firm 3, right? So the feminine has 50% of ownership in firm 1. And then we know that firm 1 will buy 50% of firm 2. So this implies the ownership of the feminine in the second firm would be 25%. And then firm 2 will buy 50% of firm 3. This means the feminine's ownership in the third firm is 12.2%, right? What I can see here is in the third firm, the feminine has very small, not very small, has a smaller ownership percentage, only 12.5%. But the interesting thing is the feminine still controls firm 3, because first you can see that this feminine definitely controls firm 1, right? With let's say 51% ownership, or just 50%. And next, this feminine can control firm 2 through firm 1, right? Because firm 1 is like the largest shareholder of firm 2, right? So in this case, you can see that feminine controls both firm 1 and 2. And then we know that firm 2 controls firm 3. So the feminine can control firm 3 through its control in firm 2, right? So you can see that this is like a pyramid structure, right? This is the top of the pyramid. And then you will go down this pyramid and continue to go down. And as you go down the pyramid, the ownership stake of the family becomes smaller and smaller. But the interesting thing is the family will through control the firm, right? Through other firms. It's like the family has only 12% 5 ownership stake in firm 3, but it can control firm 3 through firm 2. Okay, now let's see a example. So this is an example for a Italian family. So let's say this is, I don't know, Pezzenti, or yeah, I guess it's Pezzenti family. So this family has this pyramid structure, and the time of this pyramid is 1995. And we are talking about 5 firms here. I guess these firm names are in Italian. So let's call this as firm A. Obviously, I don't know how to read these firm names. And this is firm B, firm C, firm D, and firm E. And then let's see how the pyramid works. First, this family controls 29% in firm A, the top of the pyramid. And with 29% ownership, the family has 55% voting right. Well, maybe because there are some dual class shares, right? So this family has shares with higher voting rights. So even with 29% ownership, it could have 45% voting power. And next, we go down to firm B and firm C. So these percentage numbers in blue, they are prior firms' ownership percentage. So basically this 32% means firm A owns 32% of firm B, right? Similarly, this 22% means firm A owns firm A owns 62% of firm C. And then these red numbers, they tell you the direct ownership of the family, right? For example, how do you get 10%? Well, 10%, roughly speaking, is the family's ownership in the first firm, firm A, times the firm A's ownership in firm B, 32%, right? Or we could also look at firm D. In firm D, 74% refers to the ownership stake from firm B. Then how do you get 7%? Well, 7% is just 29% times 32% times 74%. Right? So 7% is the family's direct ownership in this firm D. And also you can see that there are different voting right and ownership, right, in like every firm. Oops. Right, in every firm. For example, for this 7% ownership, and then the family has 45% voting right. So again, you can imagine this is down through dual class shares. This family simply owns shares with much higher voting rights. Okay, so what you can see here is if you move down the pyramid, right? So this is a pyramid because you can see that this is exactly a pyramid, right? And if you go down the pyramid, so you go down the pyramid, you can see that the ownership, the family's ownership becomes lower and lower. Right? So in the first firm A, the family's ownership is 29%. And then in the second firm B, the family's ownership is 10%, and in firm C, 18%. And now if you continue to go down the pyramid, the family's ownership becomes 7% and 7%, right? So as you go down the pyramid, the family's ownership stake decreases. And this will have some implications on the family's cash flow, right? Because if you think about the firm's dividend, right, it's always one share, one dividend, right? So this basically means if you look at the case of firm D, right, this firm, in this case, you can see that the family has 7% direct ownership. It means the family can get 7% of all the dividends paid by firm D, right? And then if you compare this with firm B, the family has 10% direct ownership. This implies the family can get 10% of all dividends paid by firm B. Now, if you just think about money in terms of cash flow rights, you will imagine that the family could potentially have the incentive to move money up the pyramid. That is, if you imagine the dividend here is $1, right? Or okay, let's say the dividend here is $100. Then you can imagine that the family can only get $7 because of the 7% ownership stake. But if through some technique, the family can transfer this $100 up. So let's say this $100 goes up to firm B. Now you can see what will happen, right? So if this $100 flow to firm B, then the family can get $10, right? So this is simply because the family has larger cash flow rights in firm B compared with firm D, and then the family will have the incentive to move the money up the pyramid. And this is called tunneling. So it basically means the family moves profits away from firms it has less cash flow rights to firms it has more cash flow rights. And I have explained that this rationale here is pretty simple, right? If you have higher cash flow rights, you will get more payments. So you have the incentive to move money. Oh, by the way, we talked about a example here. We have these weird names. So, I'll try to. Okay, just consider from D and B, right? So the example says we can consider a fictional scenario. That is, the family makes firm B to sign a contract with firm D. And firm D will buy equipment from firm B at inflated price, which is much higher than the market price. In this case, you can say that firm D will overpay the equipment, and firm B will profit more from this contract. And in this case, basically it implies firm D's profit will decrease and firm B's profit will increase because of this contract. So essentially, the family moves money from from D to firm B. Okay. The third difference we want to talk about is the stakeholder model. So in the US, corporate governance almost always focuses on maximizing shareholder value. So shareholders are the king here. And then most other countries, they follow the so-called stakeholder model. That is, the firm and corporate governance have to consider different stakeholders. Stakeholders here include shareholders, bondholders, and employees, and potential suppliers or even customers. So, for example, some countries such as Germany give employees board representation. So they have this two-tier board. The board from or the board composed of workers and employees, and then the board composed of management and executives. And then other countries, they have mandated works council, sort of like labor union, which are to be informed and consulted on major corporate decisions. And some countries mandate employee participation in decision making in their contributions, in their constitutions. So you can see that we have a table here which talks about different stakeholder model across different countries. Right? So we have mandated works councils and employee-appointed board members, and we also have constitutional employee protections, and also we have the fourth category, no explicit requirements. So we have Canada here, and also US here, UK here, and Australia here. Okay, okay, let's review this chapter. So as I said, this is a simple chapter, right? So I guess you could actually read it yourself because we absolutely got no formula, no calculation. Okay, first, what is corporate governance? So corporate governance is the system which tries to solve the conflicts of interest between shareholders and managers. Second, what does it mean for a board to be captured? So the story here is generally board is this internal control unit which is used to monitor the CEO. But potentially the board can be captured if the board becomes too cozy or become too loyal to the CEO. In this case, the monitoring function of the board will be compromised. Okay, 3. What is the negative effect of increasing the sensitivity of managerial pay to firm performance? So you have to think about the rationale of pay for performance here. So the starting point is we wanted to better align managers' interests with the shareholders' interests. So how can we achieve this? Well, we could use equity compensation, because if you give the firm's shares to the managers as a form of compensation, then the managers will benefit from the increase in the firm's value. So this will also benefit shareholders. So that's the rationale for using pay for performance. Obviously, we'll just talk about the benefit side of pay for performance. And there are negative effects. The main concern or the main negative effect here is due to this pay for performance, managers, they will have the incentive to manipulate the information. This is mainly related to option compensation. So basically, the firm will award options to managers. And often these options are awarded at the money, which means the options strike price equals the firm's stock price. So this will have two implications. First, the managers, they will want to disclose bad information about the firm before the option award, because this will drive down the firm's share price, which will drive down the option's strike price. And after awarding the option, these managers will have the incentive to disclose good information about the firm. And this will increase the firm's share price, which will make sure the options become in the money. So managers can benefit from the appreciation in the options values. And the second implication is option backdating, which means these managers, they will manipulate the date of the option award. So basically, they will pick a date, and at that date, the share price of the firm was the lowest. And in that case, if share price was the lowest, then they can make sure the options strike price was the lowest. So this will again benefit managers, right? Because with lower strike price, it's easier for this firm's options to become in the money, right? Okay. Fourth, describe the main requirements of the SOX Act of 2002. I could only remember we have three major requirements, right? So what are these requirements? The first is, okay, I have to go back. So the first is overhauling the incentives and independence of the auditing process. So this concerns about auditing firms. And then the second is about increasing penalties for providing false information. So this is more related to holding CEOs and CFOs accountable for the firm's financial disclosure. And third, SOX 404. So the section 404 of SOX forces firms to validate their internal control process on financial reporting. Okay, so that's for today's class. Okay.